What I want to talk about is fraternal insurance companies. They're the treasure of the insurance industry that practically no one knows about. What is a fraternal insurance company? A fraternal insurance company is a 501c8. You're probably familiar with a 501c3. There's many charitable organizations that are 501c3s. A 501c8 is a slight difference to that. It's a fraternal insurance company. They've been around since the 19th century. Most of them were created back in the late 1800s, predominantly based on either ethnicity or religion. So I'm going to talk about two of them today, GCU and the Catholic Order of Foresters. GCU has been around since 1892. The Catholic Order of Foresters has been around since 1883. The most powerful thing about fraternal insurance companies, we have other insurance companies. We have mutual insurance companies. Mutual insurance companies are great. They're owned by their policy holders. Of course, the stockholder companies, their number one interest is technically not to their policy holders. It's actually to their stock or shareholders. With a fraternal insurance company, they're actually member owned. This is really important. Their sole purpose is to take care of their members. Because they're a 501c8, they don't pay the normal federal income taxes that a for-profit business would pay. But in return, they're not allowed to keep their profits. And so they're able to create products that other insurance companies wouldn't do because it wouldn't be as profitable for that insurance company. GCU, for example, is based in Pittsburgh, Pennsylvania. I'm from the other side of the state. I grew up in Reading, Pennsylvania. Pittsburgh is the fraternal insurance hub of the country. I think that happened because of a lot of the miners, steel workers, all of that. They have over 50,000 members. They have over $2 billion of assets. None of that is crazy or anything, but this is where it gets powerful. The solvency ratio. Now, we hear right now about some bad news with last night, Israel attacking Iran, and I'm not going to get into all that, but it's creating a lot of uncertainty in the world. GCU's been around since 1892. They had the solvency ratio of almost 110%. They got $1.10 backing up every dollar. So they could pay back every single dollar that they owe every member. And remember, when you take out a policy with GCU or one of these fraternal insurance companies, you're not a client. You're actually a member. You belong to something. But they could pay back every single member and still have 10 cents on the dollar. And there's some other really good insurance companies you can see on this list here. GCU is as high or higher than all of them. And there's some very strong financially backed companies on there. GCU has never needed a bailout. They've been around since 1892. They've gone through the Great Depression, both world wars, Vietnam War, the financial crisis of 2007 and 8, where we were pretty much bailing out just about every bank. The Corona crash of March of 2020, never did they take a single dime from the government, and I think that's very powerful. The product that we use, it's actually one of our most popular products for our clients. This is called the GCU Aquila X. It's a fixed indexed annuity. And I'm not going to get into all the specifics of what the fixed indexed annuity is, but it guarantees your principal. It allows you to participate in the upswings of the market, but never the downswings. Your money is actually never in the index. It sits at the general account of the insurance company. And then what the insurance company does with this product is they buy calls and puts, they buy options to protect their downside. In this example, we have a 55-year-old. And if anybody down the road is interested in looking at this, please reach out to Logan and we can customize an illustration for you. This assumes a 55-year-old male. He has $500,000. He puts it into the Aquila. And these are back-tested, hypothetical, the last 20-year returns. And then we turned on income at age 65. At 65, they start taking out $70,000 of income. Look at this accumulation value. So the 500,000, it's growing. After 18 years, at age 73, they've taken out $630,000, and they still have $1 million of accumulation value. A lot of people, when it comes to annuities, think that, yeah, but if I die, the insurance company gets to keep all of my money. That is not the way this works. At age 73, the family would have gotten, or whoever the beneficiary would have been, they would have had $1 million left over. What I would also like to show is this far right column. At age 85, they've already taken out $1.4 million of income. They still have an accumulation value of $772,000. Now let's pretend for a second there's a long-term care event. Only about 10% of Americans have some type of traditional long-term care policy. At this point, we could use the accumulation value to help offset that event. But there's a wellness benefit rider that comes with this that says if we annuitize the contract and you need a long-term care event, in-home care only, they will double this amount. So instead of having $46,000 for up to 10 years, they would have roughly $92,000 a year to have a nurse come into the house to offset that long-term care event if they're unable to perform 2 of the 6 daily living activities. So 92 times 10, that would be a $920,000 benefit. Now, at that point, all the money would be exhausted. But you wouldn't be forced to do that. You could just keep on taking withdrawals to do that as well. That wellness benefit rider comes free of charge. That's a fraternal benefit that GCU offers. So this is a very powerful tool for retirement income. Often with investment portfolios, they talk about the 4% rule, where you can only take out 4% a year. If you take out any more, you could potentially run out of money. And that's because you're going to be subject to market risk. What's powerful about this is that you're eliminating the sequence of returns. So I like to mention that. If you have any questions at the end, feel free to ask them. We typically recommend at the very least, when you get into that retirement phase, that you have at least 30% of the overall portfolio in an annuity like this. Now we're going to go to the Catholic Order of Foresters. This is one of Logan's favorite solutions. He's done an amazing job with this. So what's really neat about the Catholic Order of Foresters, and by the way, limited membership is open to non-Catholics as well. Most companies will not write term life insurance on a juvenile, but with the Catholic Order of Foresters, they do. In this example, we're writing a $250,000 level term for 60 years. And it's only $25 a month. Logan likes to write them a lot bigger, which that's great. He's really insuring. The point of this is, why should I be writing term life insurance on a juvenile? And really it comes down to insuring the child's insurability. In Texas, we had a client came to us. The child was 5 years old and they were diagnosed with type 1 diabetes. That child will most likely never get normal rates for the rest of their life. But if they would have taken out a policy like this when the child was a newborn, they would have at least had coverage in force. But these rates here for $25 a month are locked in for 60 years, fully convertible to whole life later on. We have the same exact situation, but now it's $1 million for 60 years. And it's only $85.54. The more you buy, you get a discounted amount. And that would be, once again, fully convertible for that full 60 years. And what's also unique about the Catholic Order of Foresters is that it's the only term product on the market that you can actually change the term length while the term is in force. You can't do that with any other term. If you have a 20-year term, for example, and you want to change that term, you got to go back through underwriting to increase that term length, not with this product. Here we have a 40-year-old male. He's got the best possible rating. $1 million term is $68.77 a month. And that's good for 20 years. But what's unique about this is, let's say after 15 years, he's like, oh man, I only got 5 years left of my term. Typically, you'd have to go back through underwriting. Not with this. We would just extend the term out. And the powerful part would be you get to keep the rating that you were originally approved for. I'm going to show you how powerful that could be. I'm going to show you now a 60-year-old. So this assumes that, think about it, 20 years later, this person is now 60 years old. And typically they'd have to go back through underwriting and get a standard rating because, let's face it, as we get older, our health changes. So they don't have a preferred plus rating now. They have a standard non-tobacco rating. That $1 million policy for a 20-year term, which would run them to age 80, would be $1,084 a month. But if you had term with Catholic Order of Foresters and you want to extend that term, this person would have gotten the original rating class, preferred plus, and now they're only paying $791 a month. They're saving almost $300 a month. And if you add that up over 20 years, that's a substantial savings. As I like to say, once you take out a term with the Catholic Order of Foresters and you never need to actually increase the death benefit in the future, and that's one thing that Logan does a great job of. He does a great job of insuring people for their human life value, for their full amount. So with this product, it's quite possible that you will never have to go through underwriting ever again. And as I like to say, you're probably never going to be healthier than what you are right now.